Good day, great team. Today we are going to look at the deductions made from a salary or wages. In the previous video we looked at just quickly show you our annual salary scale. We did this in the previous video, but now we're going to look at deductions made from a salary or wages. Now, first of all, you must know that you get a gross salary or wage and you get a net salary or wage. Please remember that a gross salary, let me quickly show you in the salary journal, a gross salary is before deductions. A gross salary is before deductions, whereas a net salary is after deductions. So this is the first important thing you must remember today. You've got a gross salary before deductions and a net salary after deductions. Today we're going to quickly look at what all this deductions is. Now the first one I'm going to look at, and this is on page 221 and 222 in your textbook, and this is going to be tax deductions made from a salary or from wages. Now, first of all, we are going to look at SITE. Now, SITE is the standard income tax on employees. It's very important for you to know that SARS do not charge SITE anymore. So this is only in our work that we're going to do. I don't even think it's in the activities. It's just important for you to know that SITE means standard income tax, and this is a tax that is deducted from a salary if a person earns less than a certain amount. That's why it says standard income tax. Pay as you earn is very important. Pay as you earn is one of those things that is used in real life as well. Now, how does pay as you earn work? Each year, the Minister of Finances will give us new deduction tables. I copied an example for you from SARS for the year ending 2020, February 2020. And this is an annual deduction. This means for the whole year, this is the income tax that must be paid. I just quickly want to show you. If you earn an annual salary, a salary for a year between 80,840 and 80,889, then you will have to pay SARS 336. This is now for the whole year. We are not going to pay this amount once off. You're going to pay this amount each month. Not the whole amount, but we're going to take this and we're going to divide it with 12. So let's quickly see what our monthly payment will be. If I take my 336 and I divide it by 12, then I'm going to pay 28 Rand on tax per month. This 28 Rand I'm paying for each month is pay as you earn. Let me quickly show you how a monthly deduction table looks. I just want to zoom in because this is really small. So here you can see I've got an annual year salary of 80,868, and monthly I'm going to pay 28 Rand. This is now the whole amount of 336 divided by 12. Let's say that I paid less for the whole year. I only paid 25 Rand per month for tax times 12, which means I only paid 300 Rand to SARS. So I still owe them 36 Rand. So at the end of the year, when I fill in my tax form, I will have to pay SARS 36 Rand because I only paid them 300 Rand. Sometimes we pay more per month. Let's say we paid 30 Rand per month. Now we paid SARS 360 Rand. I only had to pay them 336 Rand, which means SARS must pay me back 24 Rand. Now this is a very Now this is a very basic example for doing your pay as you earn. When you study further and you are going to do income tax, you'll see there's much more to it than what I've shown you. But for grade 10, that's all we have to know. So we've got our two income tax deductions, which is site and pay as you earn. Let's look at our other deductions. The next one you will probably be more familiar with, and this is UIF. This is Unemployment Insurance Fund. Now, the people that work for a salary, the employee will have to pay UIF, as well as the employer, the person you work for, will pay UIF. The reason why this is deducted from your salary is that at the end of the day, when you don't work anymore, you don't have work anymore, you're unemployed, then you can claim money from the UIF, the Unemployment Insurance Fund. Remember, you can only claim what you've put into your fund. You can't claim more. And there's a maximum of 34 weeks for which you can claim. Don't look at these figures because this differs from year to year. What's important for me that you must know is that both the employee and the employer will contribute to the UIF fund. And if we have something like the coronavirus we have at the moment, there's lots of people that don't have a salary. If they contributed to the UIF fund, then they can claim a salary for the time they're not working. The next one I'm going to talk about is the medical aid. Now, once again, if it differs from employer to employer. Not all employers have a medical scheme for the people that work for them. You might know the term cost to company. If you work in cost to company, then you will just get your salary and your medical aid, your pension fund. That's your own worries. You will have to do it on your own. A medical aid is like when you put money away for the day that you are injured or you've got you're in need of medical assistance, then the medical aid will help you to pay that expenses. Sometimes they don't pay all of it, they only pay 60%. It depends from the medical aid and the scheme, the medical scheme that you're on. So, medical aid can be the employee or the employer, but not always. The same with the next one, your pension fund or provident fund. This is a fund that either the employer and the employee can contribute to this, or it's only the employee that contributes to the pension fund or the provident fund. The reason for a provident fund or a pension fund is when you're too old to work, you still need an income. Then you can claim money from your pension fund. You put money away while you're still strong and you're able to work. You put money away so that at the end of the day, when you can't work anymore, then you can use that money. And this pension fund or provident fund will also pay it out monthly to you then. The other one we're going to talk about is the Skills Development Levy. Now this is something that the employer will pay. The employer will pay the Skills Development Levy because they want to help their employees to get better at the work they do, to be more educated, to develop their skills. Okay, so the Skill Development Fund is what the employer pays, and in order to develop the skills of the people that works for him, the employees. I'm not going to go in everything because we're only going to use it as deductions when we work. Then the other one is one you've already learned in grade 9. It's unions, and we're just quickly going to look at trade unions and the role of trade unions. Remember that the role of trade unions is to represent the employees at the workplace. And in order for them to represent you, you have to pay them a fee, a monthly fee. So this is also one of the deductions we're going to look at when we do our salary and wage journal, our trade unions. These trade unions will only be paid by the employee, only the employee. So if we look at all the deductions we quickly discussed, you will have a salary journal as follows. You will have your gross salary, you will have your deductions, pay as you earn, medical aid, pension fund, UIF, your union, and then your gross salary minus all your deductions will give you your net salary. And remember I said that sometimes the employers also contribute, then we will also have our employers' contributions.